Hello, Doctor. We are from BF30303 Money and Banking Group 6. Today, we would like to present banking and the management of financial institution. This is my group members.
Hi everyone, my name is Mohan Azimi Jamilin. My matrix is BB22161118 and I'm going to present my task in money and banking. So this is my question number 3 and question number 4. Question number 3 is the balance sheet. We can see the reserve is 75 million, loan is 525 million, and deposit is 500 million, bank capital is 100 million. So what action should you take if the banks suffer a deposit outflow of 50 million and has the requirement reserve ratio on deposit of 10%? The question number 4 is about the if the deposit outflow of 50 million occurs, which balance sheet would a bank rather have utility, the balance sheet in question number 3, or the following balance sheet? Why? So on question number 4, we can see the reserve increased by 25, which is 100 million. Loans are decreased by 25 million. The deposit and the bank capital are same. So this is the answer for question number 3. Is the bank utility holds 75 million in reserve against 500 million in deposit exceeding the requirement reserve ratio of 10%. So this is the following. The formula I'm using is original deposit is 500 million multiplied by 0.1. We can get 0.1 is 10% divided by 100. So we get 0.1. After we get this, we get 50 million. After that, we have to find the remaining deposit, which is 500 million minus 50 million multiplied by 0.1. We get 45 million here. So, conclusion, if the 50 million deposit outflow occurs, the bank must decrease its requirement reserve to 45 million. However, the bank reserves level remains unchanged at 75 million. This excess reserve position allow the bank to continue its leading operation or invest these excess funds. So this is my question number 4. By comparing the balance sheet, question number 3 and question number 4, the difference, I already said this, the difference between these two balance sheet is the reserve are increased by 25 million and the loan are decreased by 25 million. So here we can say that the bank would prefer the initial position with 100 million over the 75 million in reserve. This is because the higher initial reserve level provide the greater flexibility in handling deposit outflows. Even after the 50 million outflow, the bank with 100 million in reserve would still have a larger excess reserve and allow for more leading opportunities or investment option. So that's all for me. Thank you.
Question 15. Because diversification is a desirable strategy for avoiding risks, it never makes sense for a bank to specialize in making specific types of loans. Is this statement true, false, or uncertain? Explain your answer. In my opinion, the statement is false because specialization allows banks to develop expertise in assessing and managing risks associated with specific sector over time. As a result, it leads to better decision making and potentially higher returns. Next, some of the specific loans offered to specialists may have returns that are in the line of with the bank objective. After that, divers- diversification is a sensible strategy to avoid risk and it is important for bank to specialize in making certain types of loan.
Hello, doctor. My name is Kevala Rukinathan, matrix number BB22110504. I'll be answering question number 16 and 17. Parmeshwar works as a junior analyst at a local commercial bank in India. Her boss tells her he believes that interest rates will rise in the future, but he is not sure if they will make um, more short-term loans or long-term loans. What should Parmeshwar suggest? If Parmeshwara's boss believes interest rates will rise, she should suggest focusing on making short-term loans. First of all, because the interest rate risk, because if interest rates rise, banks have to face a big loss. So by having short-term loans, they don't have to face interest rate risk. Secondly, profitability. By making short-term loans, they will be much more profitable because they can adapt their loaning habits to the rising interest rate easily because they will be choosing the short-term loans. Here's question number 17. Her boss tells Parameshwar that bank managers should always seek the lowest risk possible on their assets. Is this statement true, false, or uncertain? Please explain your answer. The bank should always not seek for the lowest risk possible. This is because when the bank choose the lowest risk possible, they are not maximizing their resources. By doing this, by minimizing their risk, they will be not be able to compete with other banks, and other banks will be much more profitable, and this will cause to um, these Parameshwara's bank clients to switch to another bank. So banks should always try to strategize and diversify their investments rather than taking low risks. So by this, they can be profitable and also be competitive. Besides that, banks should always have regulatory requirements where they have a fixed amount of risk, or how to say, um, risk, where they will only take the risk that is able to them, so they don't have to worry about taking very low risks or being having a very risky investment. Thus, banks should not take low risk decisions. They should always diversify, or they should follow their regulatory systems.
My name is Anviran, son of Kumar. My metric number is BB22161105. Today I would like to present regarding apply problem 20. What happened to reserve at banker median if one person withdraw 1000 euro of cash and another person deposit 500 euro of cash? Use the account to explain your answer. Step 1. Withdrawal of 1000 euros. When a customer withdraws 1000 euros in cash, the bank reserve decrease because cash leaves the bank. The customer deposit account, a liability for the bank, also decreased by 1000 euro because the bank owed the customer less money. The T account for the withdrawal is asset cash minus 1000 euro, liability deposit minus 1000 euro. Step 2. Deposit of 500 euro. When another customer deposit 500 euro in the cash, the bank reserve increase because cash is deposited into the bank. The customer deposit account, a liability for the bank, increased by 500 euro because the bank owns the customers more money. The T account for deposit, assets, cash plus 500 euro, liability, deposit plus 500 euros. Step 3. Net effect on reserve. After the 1000 euro withdrawal and 500 euro deposit, the total reserve of the bank decreased by 500 euro. 1000 euro outflow minus 500 euro inflow. The total deposit liabilities also decreased by 500 euro, reflecting the net change in customer's account. Final T account. Asset cash minus 500 euro, Liability deposit minus 500 euros. Reserve decreased because the outflow of 1000 euro is greater than the inflow of 500 euros. The change in the T account reflect the adjustment.
Hello everyone, my name is Muafiz bin Moshidi and today I'm going to present applied problem 21. So for the question, Angus Bank holds no excess reserves but complies with the reserve requirement. The required reserves ratio is 9% and the reserves are currently $27 million. Determine the amount of deposits. The reserve shortage created by a deposit outflow of $5 million and the cost of the reserve shortage if Angus Bank borrows in the federal funds market. Assuming the federal funds rate is 0.25%. So firstly, we need to find the total deposits. So firstly, we need to calculate the initial total deposits held by Angus Bank by using the required reserve ratio formula. So the formula is reserve requirement equals to reserve ratio multiplied by total deposits. Then we can rearrange the formula to solve for total deposits, where we got total deposits equal to reserve requirement divided by reserve ratio. So based on the information given by the question, we can compute it into the formula, which we got 27 divided by 0.09, which equals to 300 million. Then the initial deposits of 300 million will be reduced since the bank has a deposit outflow of $5 million. We will subtract the initial deposits from the deposit outflow to find the current amount of deposits held by the bank. So the formula is current total deposits equal to initial total deposits, which is 300 million, minus by deposit outflow of 5 million, which we will get 295 million. Next, we need to find the reserve shortage. So assuming that the deposit outflow also occurs toward the bank's reserves, the initial reserves will be decreased by the deposit outflow, which resulted in 22 million for the bank reserves. So the formula is current reserves equal to initial reserves minus deposit outflow, which we will get 22 million. Next, in order to calculate the reserve shortage from the deposit outflow, we need to subtract the current reserves from the current amount of total deposits and multiply it by the given reserve ratio. So the formula is reserve shortage equals to current reserves minus current total deposits multiplied by reserve ratio. So based on the information from the question, we got 22 minus 295 multiplied by 0.09, which will equal to negative 4.55, which is 4.55 million of reserve shortage. Lastly, we must find the cost of borrowing. We could calculate the cost of borrowing by multiplying the reserve shortage with the federal funds rate in decimal. So for the formula, cost of borrowing equals to reserve shortage multiplied by federal funds rate. Based on the information given by the question, we will get 4.55 multiplied in bracket 0.25 divided by 100 to turn it into decimal. So we will get 4.55 multiplied in bracket 0.0025, which equals to 0.011375, which equals to 11,375. This means that the cost of borrowing from the federal funds market with a 0.25% interest is 11,375. It implies that there will be an interest charge an interest charge of 11,375 when Agus Bank borrows 4.55 million from the federal funds market, which is also the cost of reserve shortage.
Greetings to Doctor. My name is Azrin Izwan bin Kusairi and my metric number is BB22110141. I will explain applied problem number 22. The question is, excess reserves act as insurance against deposit outflows. Suppose that on a yearly basis, Malcolm Bank holds $12 million in excess reserves and $88 million in required reserves. Suppose that Malcolm Bank can earn 3.5% on its loan and that the interest paid on total reserves is 0.2%. What would be the cost of this insurance policy? And let's move to the answer. The cost of the insurance policy can be calculated by comparing the potential earnings from lending the excess reserves with the actual earning from holding these reserves. The formula to calculate this cost is cost of insurance equal to excess reserves multiplied by loan interest rate minus excess reserves multiplied by reserve interest rate. In this scenario, the excess reserves are $12 million. The loan interest rate is 3.5% and the interest rate on the total reserves is 0.2%. The cost of the insurance is essentially the difference between the interest that could have been earned if $12 million were loaned out and the interest that is earned by holding it as excess reserves. Then from the formula, we substitute the number into the formula, which is cost of insurance equal to $12 million multiplied by 3.5% minus $12 million multiplied by 0.2%. It will be equal to $420,000 minus $24,000. And the final answer is $396,000. The cost of holding excess reserves represent the opportunity cost of not utilizing these funds for loans, which could generate higher returns. By holding excess reserves, the bank can earn less interest compared to what they could earn by lending out the funds. Hence, the term cost of insurance. In a nutshell, the cost of the insurance policy by holding $12 million in excess reserves is $396,000 per year. This represents the opportunity cost of not lending out the excess reserves at higher interest rate. That's all from me. Thank you.
For applied problem 23, Victory Bank reports an equity multiple of 25, while Batovi Bank reports an equity multiple equal to 14. Which bank is better prepared to respond against large losses on loans? The formula for equity multiple is total asset divided by total equity. So a higher equity multiple indicates greater leverage. This means that the bank relies more on debt than equity, while a lower equity multiple indicates less leverage because of business rely more on equity for financing. So the answer for reply problem 23, Batowi Bank is better prepared to respond to large losses on loans because it's lower equity multiple than Victory Bank. It shows a stronger equity position and less rely on debt. This makes Batowi Bank better prepared to face financial shock. That's all.
Discuss managing bank capital. Managing bank capital is vital for ensuring a bank's stability, regulatory compliance, and reliance against financial shock. Bank capital act as a buffer to observe losses and protect depositors, ensuring that the bank remains solvent during periods of financial stress. Regulatory framework like Basel III require bank to maintain minimum capital adequacy ratio, which are measured against risk-weighted asset to account for varying asset risks. Strong capital management also enhance shareholder confidence, support growth, and provide a foundation for expanding lending activities while mitigating systematic risk. Banks manage capital through strategies such as retaining earnings, issuing equity or subordinated debt, and optimizing their asset portfolio to align with regulatory requirements. Effective planning involves stress testing, scenario analysis, and balancing profitability with safety. However, managing bank capital presents challenges, including economic fluctuation, the high cost of raising capital, and the need to comply with increasing stringent regulation. By maintaining sufficient capital and adopting prudent risk management practice, bank can ensure long-term stability and sustainability growth. Thank you. That's all from us, Doctor.